Jerry Abrahams,
Present.
Alexandra Dawn. Phil
Sorry,
DeFon.
I'm present, Alexandra.
Okay, thank you. Phil DeFonso. Timothy Hodges.
Here.
Kathy McKinnon.
Here.
Commissioner Perez.
Here.
Franklin Perry. Sarah Sanders.
Here.
We have a quorum in attendance for the meeting.
Great, thank you, and good morning, everyone. We have an agenda today with one action item, several reports, including on a bond sale from Bank of America. One of the things on my mind is the Fed move yesterday of 75 basis points, and what that will mean for our short-term investment fund. I was checking our daily rate. It was 1.62, but it should move with that Fed rate move and getting it up into the maybe 2.3% range, which for CHAFA and for our division at the Treasury is a positive to get better return on our short-term funds. I think I saw in the investment report, 28% of CHAFA's assets are in stiff or money market funds. So that's the good side of the Fed move. And we'll be looking forward to increasing that stiff rate.
Absolutely, Sarah. I'll be like knocking on Mike Terry's door.
Look at the yield curve and see, it must be so inverted. It's going to get so inverted, but
yeah. And then, yeah, we definitely can ask BofA, Barbara and Joe when your turn is up to give a bit of the market color, because this morning, they did release the GDP. It is negative 0.9. Anyway, like Sarah mentioned, we do have one action item to present to you this morning, along with to the full board, is in regards to our external auditors selection. The resolution before the authority requires us to select and conduct an RFP every 3 years for an external auditor. The last RFP was conducted back in 2019. In connection with the RFP that we published last May, we did receive 3 proposals. Each proposal was reviewed and evaluated based on the firm's experience, qualification, and competitiveness. Our summary findings and the supporting documentation are included in the packet. Based on the analysis of each proposal, we are recommending the firm identified in the resolution to act as the authority's external auditor. The appointment will be effective for the preparation of the authority's audited financial statements for the calendar year 2022, 2023, and 2024. I'll be happy to answer any questions the committee have regarding the recommendation.
one question I had, Hazim, was there was a footnote that one of the firms previously served as an auditor from 2010 to 2015, but I couldn't figure out who the footnote went to. I don't think I'm revealing anything by asking this question. I know CLA and Bloom Shapiro have been our auditors for a while, but who was the prior auditor?
You have CLA, you have Bloom, you have EY, you have Whittlesey. So we did utilize them in various capacities. Some of them as our external auditor, but then some of them we asked them to perform certain specific functions.
Because there was a footnote 1, but then I couldn't find which firm it flowed to. Maybe it was Ernst & Young.
Number
Yeah.
1.
EY and Whittlesey.
Oh,
Yep.
both of them. Okay.
Mhm.
Yeah.
I couldn't figure that out. Well, I don't know what our procedure is because it's kind of a confidential matter. I did have a chance to review it. It looked like the staff did a good job. And I particularly focused on the housing experience, because housing is a special niche, even for auditors. And the recommended firm seemed to have some very good experience with other housing entities. So how does it work, Cosimo? Since it's kind of confidential, are board members able to ask specific questions, or are we?
Yeah, you can ask specific questions, no different than when we presented the bond underwriters. If
Yep.
there's something specific that you want to ask, but if not, we recommend the committee to vote in favor for the recommendation, and we'll present it again to the full board.
I mean, one thing I noted, you only received 3 responses, last time 5. And it does seem like the field is shrinking a little bit. You know, CLA took over Bloom Shapiro. And some of the big firms don't really respond, right? Like Deloitte. Are you finding it's a bit of a shrinking, or maybe the housing space limits it because of your housing?
It is a combination. Part of it also has something to do with the competitiveness and the fees. We did receive in the past, responses from, one of the big fours, or we tried to invite them. But when they were able to decipher, the general fee we would pay for this engagement, they took a pass.
I do want to add, there's been a lot of chatter on the GFOA page that other municipalities are running into the same issue with getting very few responses. So we're not the only ones by all means.
So the industry, yeah, may not be that profitable and has a lot of risk. but
Right.
anyway.
Mhm.
Jerry?
Hazim, what are we paying now?
About 100 is on the budget here. 100. What was it, Elson?
It's low, like 110. I'd have to look it up, but it's in the low 100s.
So assuming we go to the recommendation here, but it's not going to be that. I mean, it's up a little bit, but not
Very
That's
similar.
correct.
right. I mean, and I assume just that the fact that that Whittlesey, low bid, is because of, more sort of Connecticut focused than, PKF and E&Y.
Yeah.
You just expect as like a more regional firm, they're not paying the same professional fees as I guess the larger guys are. We're paying at a more kind of national rate.
I think it's all about how each firm deploys its resources. When you look at the bigger firms, they do have, or they do operate by region. So for example, when we issued the 2021 audit, and the audit was performed by CLA, the partner and then the manager that was conducting the audit, they did have to send their review, their report to the regional office, and then it goes multiple layers. So every time when our file touches a particular unit, and as it goes up, it just adds all the costs.
Like a law firm, yeah.
Yeah.
Commissioner Perez, you have a question?
Yes, I do. Thank you. And my question is more about, look, I've been a member of SHAFA twice. I have had 2 run at it, one many moons ago, and then now as commissioner, and this is my 7th year or so. And I've been through this process of selecting auditors multiple times. And my biggest question is, what is this whole secrecy and confidentiality that we're so worried about? I mean, I never saw that kind of focus before. And considering that we're a public agency and that we're supposed to be transparent, what is it that I'm confused, because nothing that I've read so far really, I will argue that it's really confidential. And that's curious. I mean, because I'm very much for transparency, believe it or not. And I just don't feel comfortable when we try to at least give the perception that we're trying to hide something or something's confidential. When you're a public agency using public money, really there's very little then that would qualify for confidential. So I was just curious if you could address that issue, Betsy.
Sure. So the the term confidential is more meant to say that the engagement or the responses is still under review until the board has acted and approved the recommendation by staff. So the intent is not trying to be transparent. You know, we do want to inform, but part of the challenge has always been when it comes to a RFP is we may go through a process of evaluating and recommending, but nothing is final until the board has taken action. So that's the only intent.
That's true with everything we do. Nothing is final until the board takes an action, including bond sale and so forth. Look, I just want to be cautious about overusing the veil of confidentiality when something is really not confidential. There's really nothing confidential what we're doing here. It's very knowledgeable that we pick an auditor every so many years. There's no secret sauce that I saw that you guys use that average agency of our size or typical would not use in evaluating an agency, right? I mean, an auditor. So,
Right.
And look, I just want to be cautious about it because it
Yeah,
bothers
no,
me. It bothers me. That's all.
I understood. I think, you know, and again,
Because there's nothing confidential so far that I've seen, to be honest. And if anything, we're depriving ourselves, the general public, to be able to comment if there was any interest from anybody, you know?
right. And the way that we have been operating is that once the board has taken action, and if anyone wants to get more information about, you know, how we go about, you know, selecting one, you know, we do share that information.
Again, like I said, this is not my first rodeo selecting an auditor as a member of CHAP. This is the first time I've seen this kind of emphasis on confidentiality, and it has worries me. That's all. So I just want to go on record saying that I don't like it.
Yeah, we definitely can.
And we should be as
revisit the-
transparent as we can in everything we do. We all that because we're a public agency. That's all I got to say. I want to be on record on that.
Yep, understood. We have been doing this since I started, so we definitely can revisit the whole process.
Maybe I fell
Is it-
asleep the other 2 times that we've done it since you started and I've been here, but I don't remember it being this.
We haven't changed auditors in a while, so maybe not.
Well,
Azim,
I
is it-
know since I've been here, we've changed it at least since my second time around. This would be at least my
Yep.
second time, if not my third. And again, like I stated, I served another 6-8 years prior to being commissioner. You know, and then there was a break because I told the then governor to go fly a kite because they wanted me to vote a particular way, and I did it.
Yeah, I'm
On
trying to
the
think.
project that we did took a big loss on, by the way. but that's a story from another day. Thank you. Again,
Yeah,
I just want to be on the record.
I'm just thinking of the chief of board that I was on for 10 years and all the RFPs, you know, because all the quasis do RFPs. And as I recall, like none of the vendors actually come to the finance committee meeting, but they do to the full board meeting. So I think part of it is, you know, to have the vendors finding out before the board. We might want to check on what other quasis do because they're all doing RFPs every 3 years and just to see what the best.
And again, I'm not saying that we shouldn't do RFPs.
Yeah.
That's
No, we
good.
have to do RFPs, yeah.
All I'm saying is look at all the hassle we went this morning about the folder and how many times the word confidential was done. Even your question about can we even ask questions because it's
Right.
confidential. And I'm saying is I don't understand the secrecy at this point.
Well, they
right?
might be on the phone, some of our vendors, you know, I think that's
But
the,
they should be because maybe we misunderstood something. Maybe there's some
Right.
additional information. I mean, that's the whole point. There's nothing secret of what we're doing, people.
Yep.
At this point, staff has already done their work. Staff is making a recommendation. That's not a secret.
Mhm.
And again, I don't want to take over the meeting on something that is not as germane as picking the person, but I just want to be caution about overusing the veil of confidentiality when we're a public agency. And if you really read the law, you know, I will argue that we're wrong, to be honest with you. No, at the end of the day, there's really no harm, but anytime you're gonna, I come from the school thought, anytime you're gonna restrict the general public for information that they should be entitled to, I have a problem with. But that's me. It doesn't make it right. Again, it doesn't make it wrong, but
Any other questions and comments?
I had a question. So Whittlesey does do a lot of cost certs and works for a lot of 9% and Jaffa developers. Does this set up any potential conflict of interest? Is that how it works with accounting firms as opposed to legal firms?
Yeah, we did look into that, and we are comfortable with the response because, you know, just like law firms, they do have walls that they do need to maintain and manage that conflict of interest.
But circling back to the commissioner's prior point, I guess just to see if we would take some kind of action. Hazim, would it be possible to have Teresa kind of weigh in on the matter, and then we would then, once she looked at it, we could then decide what our policy should be with respect to doing this stuff. When it should be confidential, just, you know, and just we could have then basically a best practice. We may be allowed to keep it confidential, but to the commissioner's point, which I think is a valid one, why the work we're doing here should be transparent. There's no secrets. There's no reason. There's nothing here that should have been kept confidential. He ran a very professional process, and it should be open.
Jerry, you hit the nail on the head. It's discretionary, not mandatory. So if the board prefers it to be open to everyone, that's perfectly fine.
So it's a matter of board policy, and I guess we would defer to staff to come up with something that works for them, and then we can decide on it.
And I'd like to know what the other quasis are doing. I have a feeling, well, I don't know. Any other questions on this matter? Can I have a motion to accept the resolution?
I'll make a motion.
Second.
Thank you for the second, and we'll have a roll call vote.
Jerry Abraham.
Aye.
Alexandra Dahm.
Aye.
Tim Hodges.
Aye.
Kathy McKinnon.
Aye.
Commissioner Perez.
confidentiality, yes.
Sarah Sanders.
Aye.
Phil DeFranco. Franklin Perry. The vote passes unanimously.
Okay, back to Hazim for the report on bond sale.
Okay, so here we have today a representative from Bank of America, Barbara Feldman and Joe Anito. And they're going to provide the committee the experience we went through from the time the board approved the resolution to the time that we closed, which was earlier this month. It was a somewhat of a roller coaster, I would say, but we did get it done, and then that's because that we had a very good team to do what was required. So Barbara and Joe, take it away.
Thanks, Hazim. Good morning, everybody. I'm the barber of Barbara and Joe, if you don't know me. And on behalf of Bank of America Securities, I want to thank the authority for the opportunity of allowing us to manage your last fixed rate single family deal. This was the first sale since the underwriting selection for us. And Ramirez was designated as co-senior manager, and I think it was JP Morgan did the floating rate piece of the transaction, and everything worked very smoothly, and there was good communication with the group. So we think you guys should get some feedback on how that's all working, and it's working pretty well. My part of the presentation is just to give you a little market color on what the market was like when we did the deal. I wouldn't dare predict where we're going with this market. It's really quite interesting, to put it mildly. When we entered the market in late June, There was a lot of volatility, which continues. Virtually all the interest rates have been increasing, obviously, as the Fed has taken action. And when we sold, it was a week and a half after the Fed had raised rates 75 basis points. And when they promised that more was coming, which in fact came yesterday. So they raised it up another 75 bips. So I think part of the reason that Hazim alluded to it being an interesting sale is that not just the volatility, but the pressure on rates was sort of well manifested in this market. We all felt pressure to keep the rates as low as possible, and maybe just to give you a feel of how housing affordability has been impacted by what's going on in the market. If a home buyer bought a house last year in Connecticut, the average increase was something like 3.5% in the value of that house. And interest rates have gone from about 3 to 5.5%. So if the same buyer came to buy that house today, his cost would be up to about 153% of what he paid, what it cost him to carry that house the last year. So that's quite a dramatic increase for anybody. And given all the other inflation that's going on, one can recognize why there's so much pressure on getting a good rate. So with that, I'm going to turn it over to Joe, and he'll explain what happened and some of the creativity we applied to the whole group applied to the transaction. Joe?
Great, thank you, Barbara. I'm going to quickly run through the public sale, and then I'm going to discuss the bank purchase, which was a private placement, which helped to drive down the financing cost and keep your program affordable and profitable. As Barbara said, we were mandated to manage both the long-term financing here, which provides money to make the permanent loans, and a short-term financing to warehouse volume cap so that later on in the future, it can be turned into mortgage loans. So there were
Joe?
Yes.
Sorry to interrupt. So Lorraine, can you?
Sure.
The page. So Joe, let Lorraine know which page that you
Oh,
want to
okay.
highlight.
Yeah, sure. These general comments really relate to this first page that you're on, which has kind of the summary of the transaction. Perfect. So as I said, there were 4 components to the transaction. There were C1, 2, 3, and 4. The C1 issue was the traditional fixed rate bond financing that you typically sell to fund the lending program. That component was $48.5 million in size, and those bonds received $156.5 million of total orders, of which $112 million of the orders were from long-term investors, either institutional or retail. So essentially you had 2.3 orders for each bond that the authority was offering to sell. When we went out, we were able to lower the yield from the time we went out to the time we committed on the transaction on some of the earlier serials by between 5 and 10 basis points. And on the term bonds, each of the 3 term bonds, by another 5 basis points for each of them. So those results are shown on what's called PDF pages 7, 8, and 9. So if you kind of just flip ahead, you can keep going. Next one. This would sort of show you the order flow by maturity. The next page breaks out the types of investors that bought, whether it was a member order or retail, a national retail order, or local Connecticut retail, institutional, et cetera, and then the allotments associated with that. So, obviously you have more bonds that are sold than can be allotted to investors, and you'll see that we obviously over allotted to the Connecticut retail sector, which is the one that we are most interested in sort of courting because we get the most pricing leverage from that. So to sort of turn back to kind of the actual process of the transaction, there was also this C4 issue, which was a short-term floating rate issue. That one was 100 million in size, and that was used to essentially carry volume cap forward. And it was until in the future it's used to finance mortgages. We began the marketing for that at a spread. It's a short-term bond that floats. We began the marketing for that at a spread to the short-term tax-exempt index of SIFMA plus 65 basis points. By the time we committed to purchase the transaction, we had 199 million. So we had essentially 2 orders for each bond available for sale. And we were able to lower the rate on those bonds by 2.5 basis points. And so ultimately we committed to buy those bonds at SIFMA plus a spread of 62.5 basis points. And those bonds will change on a weekly basis based upon the short-term floating rate index. You also marketed floating rate bond, which, as Barbara alluded to, JP Morgan sold. And I know that later on in the agenda, you'll talk about swaps. That bond, which was a $20 million piece of the transaction, was synthetically fixed in its interest rate through the use of a swap. Your financing cost on that portion of the issue was about 327, which is about 150 basis points lower in cost than had you sold a natural sort of traditional fixed rate bond, which is why you essentially use the swap execution and why it was included here, because it helps subsidize the cost and bring down the overall financing cost of the transaction. The bank also did what we call a direct placement with BANA, which is the Bank of America NA. That was the C3 bonds, and that was in an amount of $31.5 million. CHFA had initially intended to sell an $80 million transaction in conjunction with this $20 million, which was swapped. But we chose to alter that based upon market conditions at the time of sale and the volatility and the spread widening that was happening. One of the drivers of your long-term financing cost is a special bond that we sell, which has certain prepayment characteristics, and that bond is called a PAC bond. PAC bonds typically represent about 30% of the portion that's used to finance the fixed rate piece of the transaction. That segment in the market's been under considerable pressure over the past year. So to bring that into focus, in September, when you sold your single family deal, the PAC bond was sold at a yield of 80 basis points. So that's less than 1%. By March, when we rolled around and you did your prior single family deal this year, that bond was sold at a 210. And as we approached this sale, the market clearing rate for that bond would have been just over 370. So that's gone up 4 times from the cost of last summer. So in conversations early on with Hazim and Bob, we identified this increased cost as an issue. And we worked internally at Bank of America to develop a proprietary product, which is similar but not identical to the publicly offered PAC. We call it a bank PAC. Since BANA or the bank funds purchases in the tax exempt, or differently from where you fund in the tax exempt market, we were able to take advantage of an arbitrage between those two markets. And we directly purchased that bank PAC at a cost savings of about 40 basis points in yield. This was a first in the market. It was a unique execution for CHFA and for BANA. And because it was a direct purchase, it didn't have the publicly offered costs associated with it. So there was no takedown and no management fee. This execution was only really made possible by a lot of early planning, discovery in conjunction with the finance team to make sure that the structure would fit not only within the 4 corners of the resolution, but also that the differences between this alternative and the typical PAC bond were modifications that CHFA was comfortable with. And clearly, this came about because Hazim encouraged early on us to investigate all the different alternatives. And Bob was very helpful in making sure that the transaction fit structurally, could be administered appropriately, and satisfied the needs of CHFA. And so, there was a lot of, we broke some eggs along the way. I think we may have given Hawkins a nervous breakdown, but in the end, it was a very powerful way to subsidize the transaction. So the direct purchase, along with the swap and the other structural enhancements, and the strong reception that CHFA has in the market produced a bond yield of 3.72, which will permit you, based upon the allowable spread, to keep your mortgage rates at around 5%. So very competitive. And with that, I would open it up for any questions.
This sounds like one of the most interesting deals I've heard of recently, and seems like you were very flexible in coming up with that direct placement for the PAC piece at the end. I know that can be tricky to do that, a public and a private offering pricing side by side. In theory, you could have done an underwriting, I suppose, with the investment bank as opposed to going over to the credit bank. That would be a very large underwriting of a PAC bond, though, right?
Yeah, I mean, essentially, because of Reg Q and how it relates to sort of the separation between the bank and the investment bank side, we thought that this was the best execution. Interestingly enough, when we came to market, the investors noticed that a PAC bond was missing from the transaction. It had been described in the POS and it was not being offered, and PAC spreads had widened. They're right now, or back then, it probably had widened out to about 140 basis points. Over the summer, they were about 60 basis points last year. So, you know, what had happened was some of the accounts called up and they're like, what happened to the PAC bond? And we're like, well, it's being privately placed. They're like, well, we have PAC bonds. Would you like to buy some of ours? There was a lot of stress in the market at the time. And what doing what we did allowed for was a much smaller public offering on the fixed rate bonds. And you really, when you have fewer bonds to offer, oftentimes it's much easier to clear the market. And with a great name like Connecticut and the strong retail, we took a piece that was essentially an institutional component out of the transaction, and retail became much more powerful. When we went out on Monday, the retail demand was so strong that it allowed us to leverage that and do the transaction in a single day. And I think that part of that strategy, there's a lot of science in pricing, but there's also a lot of game theory. And I would sort of point to Bob as very instrumental, along with with Hazim, in helping to figure out the best strategy and to make sure that we went out at appropriate levels so that we could build a book and then tighten based upon the strength of that book, as opposed to trying to go out at absolutely the lowest yield and hope that investors would show up. So I would say that in general, the working group really worked quite well together in coming up with a strategy and executing that strategy. You know, plans are nothing, planning is everything. And when you take a lot of time to make sure that there aren't any hiccups and that you've investigated and unearthed all the different questions along the way, usually you're better off because you don't get surprised. To your point, though, earlier, Sarah, about sort of short-term rates and them ticking up, absolutely that's happened. If you look at the last reset of SIFMA just came out yesterday. That's the short-term index. It was at a 133. The week before, it was at 65 basis points. So a lot of the news is starting to filter in and affect rates. The curve itself, as you pointed out earlier, is inverted. The 2-year treasury is a 297. The 10-year is at a 273. That was as of last night's close. And so that typically signals recession. Because of the steepness of the municipal curve and how flat the treasury curve is, that's part of what we were able to exploit with the bank PAC, because the bank funds in the taxable market, and then we convert essentially over to capture that gross up in the tax exempt market. So, you know, there were a lot of pieces at play here, but it came together quite nicely because everybody sort of did their part to investigate and unearth all the different issues before we did come to market.
So it sounds like the bank PAC, I thought it was more of a cleanup for unsold PAC bonds, but you went into the transaction with that employed already, anticipating a problem?
We were very cautious that the deal be offered publicly if it made more sense. So everything was set up to do the public deal, but have this in the background if the execution warranted. And in fact, the authority made that decision like Friday before the Monday we started. And, because we're on the books, we were aware that, we're in sort of a semi conflicted position, and we made sure we solicited all the views. And I know Bob and Hazim checked the markets around us to make sure that this execution was in fact better. And had it not been better, we were all set to go with the normal deal. So I think there would have been demand, but it would have just been really expensive. And as Joe mentioned, the fact that it wasn't being offered focused to everybody on the long bonds that remained, and they got a pretty good reception on those. So it had a byproduct.
Well, not all underwriters have a bank side, so it's
Amen.
fortunate that you were doing this deal.
Absolutely.
Hey,
Jerry,
Joe,
you
I
have-
just, and look, and I know that, investment banks, buy, direct purchases all the time, and want to thank you for doing that. But I always am curious that if and I understand your bank gets it for the gross up and from the relative yield curve versus their taxable funding. So it looks profitable. But if I'm at the bank, I guess I would say, well, if I can buy cheaper bonds on the secondary, why wouldn't I do that as opposed to buying richer bonds on the primary? And again, I know I'm not trying to single you guys out. I know we appreciate the help and other people do it. So I know that this is perfectly normal. I just never quite understood sort of like what am I missing in my simplistic way of looking at it?
Yeah, I don't think you're missing anything. As I said, and maybe it was a little bit subtle, it wasn't identical to a publicly offered PAC. And so essentially we booked it as a loan. So we were able to get some favorable treatment on that basis.
Because you don't mark to market, I guess you just hold it.
We carry it
hold
as
to
a loan
maturity.
and don't have
Yeah.
to market, right? So that's one difference. It doesn't have a QSIP. It's not essentially, from our standpoint, a security. So those are a couple of the subtle differences. The other pieces are that we could actually, to your point, buy a regular PAC, and then why wouldn't we take the extra 40 basis points and put it in our pocket? The difference is that a regular PAC is fixed under all circumstances. You pay typically a 5% coupon and it's priced to yield, call it in this particular case, we bought it at a 331. We priced it at par, and to the extent that you fall outside of the band, rather than you pay the 5% coupon, we convert that portion to a floating rate. And so the bond itself does not look identical, because if we took it to the guys and it was identical, they'd say the same thing that you did, which is, why the heck would we do this, Joe? So we had to make it different enough for them such that it catered to what their needs were, but it also was such that they weren't sort of looking at that and saying, this is a terrible deal for us. We'll just wait and buy the bond in the primary market when it comes.
I guess you're doing it as a loan, you have the ability to do that. And I guess the second question, when you purchase a portion of a bond to a related entity, and I guess it's not technically a bond, it's a loan, it doesn't have QSIP, but it's still, but it's still tax exempt. Does that end up, I guess this is what gave Hawkins trouble with respect to our tax opinion and all of that. Was there any changes to that, or I assume we just get what we normally do with respect to, the issue price certificates and all that kind of stuff?
Yeah, I think there are representations that are made, and we didn't underwrite that bond. That bond was directly purchased by BANA. So
Okay, so it's outside, yeah.
Yeah, so it's outside of that portion of the transaction. Our deal was really from the banking side, C1 and C4. Those were priced far enough apart that they were not a common plan of finance. C2, which JP Morgan did, was a portion of the same finance plan as the long-term deal, and that will be included. And C3, because of the pricing within that 15-day window, was also part of the same plan of finance. But again, it was done by BANA. BANA will provide certificates as to the fair value of that security, but it wasn't really part of the underwriting, if you will, that we did.
Got it. Thank you. I get my last question and then I'll go here. On the C2 was I guess this is really for you, Hazim. The C2 was the FRN swap to fixed.
No, C2 is just our variable rate bond,
Okay. Then this,
long dated, and then we put a swap on it.
well, right. I'm sorry, not FRNs. They're okay. So they're
The
floating.
FRN is the C4.
Okay, so I'm sorry.
the-
The ones we did the synthetic fixed on were just regular VRDOs. So in the VRDOs, you swap to fixed. Do we also though look at, so on those though, we of course lose our par call relative to just doing traditional fixed rate. And so when you look at the savings, I assume we're taking into account that we're losing the value of the option. I mean, with over 100 basis points, I'm sure it's, that's in excess of that, but you do look at the fact that we lose the optional call
Right.
on this stuff, I assume. Okay.
Yes.
It's not a
Right.
callable swap, a 10-year call on the swap? No?
Yeah, it's at 10. 10, we do have a par.
But you do have a 10-year call and swap.
Yeah, yeah,
Oh,
yeah,
okay. All right. Wow. Okay. Thank you.
Commissioner Perez?
It's more of a comment. I mean, I think this whole thing was great and wonderful. Great job, everybody. But from a regulatory perspective, the fact that Bank of America is a super large bank, when it comes to community investment, that process is a little different for the larger banks than the mid-size and the smaller banks. This may be unique enough or creative enough that your CRA people should know about it because it may help you with your primary regulator in that world. Because facilitating affordable housing and being creative is one of the things that look for the big banks. And I'll give you kudos for that.
Great. Yeah, we're aware, hopefully they are aware as well, but we appreciate
Right.
it. Thank
But I
you.
mean, that's one of the reasons why, going back to Jerry, one of the reasons why they would do it too, because that CRA rating, especially if it makes a difference between getting a satisfactory and outstanding, is worth a lot more than the 40 basis point. But I mean, this is one case, this is one example where people are using creativity to do what CRA was meant to be. And as you all know, in the past, I've been critical about the banks when they don't do that. So, and Bank of America is not even one of the banks I regulate because they're federal. So I have nothing to gain by praising them or on stock or anything like that.
Take it where we can get it.
Right. Right.
Something tells me the bank pack is going to be a new product on the street for everyone.
It should be because it's a nice feature, but again, it has this unintended, or maybe it was very intended consequences, right?
Yeah. Well, it was interesting because when we started talking with Hazim, he expressed to us, what he would like and what he didn't like. And then we knew what the bank would like. And then we went back to the drawing board and sort of concocted this thing, which looks and smells like a pack, but then flutters at the back end. And, we couldn't have done this with many clients, but this group is, really quite sophisticated and everybody is on the same page. And it, was not painful at all. So we do appreciate the opportunity to work with CHFA on this one.
Any other questions, comments? Okay, next on to the financial report.
Good morning. Before you are the June financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 801,000 below budget for the first 6 months of the year and 3.4 million lower than last year. As you can see, and as Sarah mentioned, the increase in short-term investment rates is helping us close the revenue gap. We're still seeing a continued decline in prepayment rates. Prepayment rates in June alone are down 50% from last June. And to give you an idea of the dollars we're talking about, last June we had prepayments of $45 million. And this June they're down to 22 million. On the expense side, bond interest expense is below budget by 8.6 million through June 30th and 8.9 million lower than last year. The authority had additional special redemptions in June, resulting in additional bond premium amortization of 2.5 million. In addition, the authority's outstanding bonds as of June 30th are $370 million lower than the same time last year. These two items account for a large portion of the variance. Administrative expenses are coming in 4.2 million under budget and 424,000 higher than last year. When you exclude salaries and benefits or 13.4 million, current year expenses are 538,000 lower than prior year's expenses. The salaries and benefits continue to be a large portion of the current year budget variance. CHFA is approved for 148 positions. And as of June 30th, we had 125 FTEs on staff. We're actively recruiting for 10 positions right now. And lastly, the change in net position is above target by 12.6 million. Are there any questions?
There's no questions. We'll go on to the delinquency report. John Chilson.
Good morning. For the month of June, the authority purchased 151 loans totaling $29.1 million, of which 124 loans totaling $23.2 million were securitized, or 82% of our production. The remaining 27 loans totaling $5.9 million were whole loans. The average loan size was 192,000.5. The June month-end mortgage-backed security balance was 2.1 billion, an increase of 2.4 million from the prior months. This is the first time we're reporting a monthly increase in the MBS portfolio since July of 2020. That's due in part, as what Allison mentioned, the slowing rate of prepayments, but also the increase we've been realizing the last few months in production. The whole loan portfolio, though, did decline by 100 loans or $11 million with a total portfolio balance of $1.2 billion. The overall delinquency rate increased by 1 basis point to 2.32%, while the carrying balance for loans in foreclosures year over year decreased by $10.4 million to $27.3 million, while the number of loans in foreclosure decreased by 65. For the month of June, the authority also funded 87 down payment assistance loans totaling $1.3 million with an average loan size of $15,400. 58% of our June borrowers took advantage of the down payment assistance program. There were no new closings in our multifamily portfolio for June. The portfolio decreased by 2 loans to 552 loans with a portfolio balance of $1.3 billion. There were 6 permanent loan delinquencies, which is unchanged from the prior month. There were no construction loan delinquencies, and the overall multifamily delinquency rate was 0.6%. Any questions?
Yeah, I had a question. I noticed that the average loan size has gone down. I mean, it's been steadily going up. Do you know why that is?
It does seem to vary a lot month to month. I was surprised to see this month that it was less than what had been averaging. You're right, it had been averaging around 210 the past few months. I'm not sure what accounts for the smaller loan size.
Any other questions for John? Okay, on to the investment and swap report, Hazim.
So for the investment quarterly report, this investment report does reflect a decrease in book value by about 247 million to 3.4 billion due to bond debt service. Quarter over quarter, the yield to maturity did go up to 2.21 from 1.77. I do want to point out the committee, we did provide a refresh to our investment reports. We essentially looked at what we previously provided to the committee and determined that there was some information that may not be relevant. So essentially, if you have a chance, take a look at it. We broke it down by the major programs and then list out the big investments that we typically will be putting our money in. One of which will be the short-term investment fund held by the state treasurer. We do invest in U.S. treasuries. We primarily invest in mortgage-backed securities because those are our program assets. And then when it comes to the swap report, it still show a position of 40 swap with 9 counterparties with a notional amount of 920 million. It does reflect a decrease of 10 million, and that's due to amortization. In terms of our pay rate by the authority, it did go down from 3.05 to 3.26%. And the mark to market did increase by 71 million, and that's due to the increase in interest rate. I'll be happy to answer any questions from the committee regarding the investment and swap reports.
I did check in with Mike Terry, who runs our short-term investment fund, and he says that the rate won't go up 75 basis points right away because they have a lot of securities that go out longer that need to mature, but he thinks it will crack 2% shortly. So that would be good.
That will be good.
Yes. Our next item is approval of the minutes of the Finance and Audit Committee meeting from June 30th. May I have a motion?
So moved.
Second,
I'll second it. This is George.
thank you. Roll call vote.
Jerry Abrahams.
Aye.
Alexandra Dahm.
Aye.
Tim Hodges.
Aye.
Kathy McKinnon.
Aye.
Commissioner Perez.
Yes.
Sarah Sanders.
Aye.
The vote passes unanimously.
Great. So I'll take a motion to adjourn. All in favor, say aye.
Aye.
Okay,
Aye.
thank you. Right on time.
Terry? Terry?
Oh, I'm sorry, Commissioner. Yes?
No, no, I